Nothing in this recording is intended as investment advice, and the people in this recording may hold positions in the companies they talk about. Do not make any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to Zak's Traders Cafe. Today I'm joined by Carl Herberger and Chris Goulden, who are CEO and CFO respectively at Corero Network. How are you today, gents?
Yes, very nice. Nice to meet you, Zach, and thanks for having us.
Quite a lot going on at your company. I think the market may have been topped and tailed by your recent news in the sense that at the end of May there was a $1.5 million contract extension, so it looked like everything was hunky-dory. And then with the half-year trading update last week, I think the threat of a swing to loss, the market's got a bit jittery, and obviously then you get the downgrades, et cetera, et cetera. So maybe you can explain what's happened and also maybe what's perhaps good about where you are now, what you're doing about it.
Yeah, sure. Well, thanks for the opportunity to kind of walk through the quarter. Overall, the business, if you're familiar with it, we make business in the cybersecurity, cyber attack space, and we're focused on keeping companies up from cyber attacks that would render them down, essentially operationally non-resilient, or they would have outages, something along those lines. That's what the company fundamentally does, Zach, and that's normally known as DDoS, the DDoS space, the distributed denial of service space. And that space has been going through lots of different changes that have had some knock-on effect in our business. So the business overall had two challenging periods that we had to we went through in the first half, and I think now we've adjusted through it. And two of them have had some knock-on effects on our P&L, and that's what you're referencing, Zach, in terms of the topsy-turvy Wall Street reaction, if you will, the market reaction to our numbers. Overall, we've had a large part of our business move towards recurring revenue. So our recurring revenues were up 25% year on year to over $20 million. In fact, I think it's just over $21 million worth of recurring revenue. I'll have Chris talk more specifically to the numbers. That handsome movement towards ARR, which is what many companies hope to achieve, comes in a dramatic change for us with a mix between our typical capital purchases by our customers and our OpEx purchases by our customers, which is normally a healthy mix. Let's call it, generically 50-50. Whereas in the first half, we had a dramatic shift towards ARR, whereas many customers that were traditional CapEx customers of ours, these are recurring customers that would normally buy capital procurements, move towards recurring or operational procurements, essentially taking their products more as a service or as a software over time, delivered over time. And of course, whenever you have a dramatic change in the way that you recognize revenue, it has a knock-on effect on the overall P&L, both in current year revenue, in current year cash, as you mentioned, and current year profits. So that essentially describes a large part of the knock-on effect to the P&L. One other unfortunate piece to the overall business was that we generate our business about 30% of our quarterly and yearly distribution of leads and deals comes through our OEM relationships. We have 3 OEM relationships, which we call our alliance partners. And our 3 alliance partners are Akamai, GTT Telecommunications, if you're familiar with it, and Juniper Networks. And Juniper Networks owns 10% of our business, just about overall. And we originate about 30%, plus or minus 25, 30%, depends on the quarter, depends on the year of our business through these relationships. And the alliance partnerships really were paltry in the first half. So in other words, we missed our expectations on the origination of our business as explained by alliances in the first half. So that's essentially what the market, I think, is reacting to in our business. Overall, we've had still continuously to be generating a lot of new logos to the business, being very competitive in the marketplace against very, very larger competing solutions with larger competing messages, marketing departments, and sales departments. And we've increased our product portfolio. Our essentially what I would call the classic Corero portfolio has been extended to now adjacent markets, and we've had our first wins in that product portfolio in the first half. I think you should see all of that as a good news story on the back end of what I mentioned with the disappointment of our alliance partners and the unforecasted revenue mix. Chris, anything you wanted to add to that?
Yeah, I think to maybe take the H1 to look at what we've projected as the outlook, Zach, and where the downgrade has come from. The reduced expectations for the full year is a two-pronged, two metrics in there, right? So we saw a delay in orders coming in from Q1 into Q2. Particularly at the end of Q1, we saw customer uncertainty in decision making, which we kind of in part relate to the uncertainties around US tariffs. Around 70% of our business is done to US customers, and there was significant uncertainty around not just US tariffs, but the change in the value of the US dollar as well. So that pushed deals into Q2, and Q2 rebounded, but not sufficient to cover that gap. So whilst we foresee H2 being strong and in line with our initial expectations, we don't foresee we're going to recover that gap from Q1. And then, as Carl mentioned, we have seen a significant change in customers buying from upfront licensing purchases, which would allow us to recognize the revenue upfront, to more service-based and I guess rental type model that we offer. So that pushes revenue and also cash into future years. So great for the future growth of the business, but it causes this timing difference in year with this significant move away from upfront revenues towards recurring revenues.
So as I understand it, there was sort of a change in your market, also from obviously 24 to, last year, your shares sort of went up 4x. So presumably the market thought, well, this company is a real winner. We're going to really back this hard. And then it turned out that the environment changed and the nature perhaps of your business environment changed as well. Is that a fair thing to say?
I think that's a fair thing to say, Zach. The back half of this year, we have not changed our bookings expectations. We still feel very, very strong about the sales pipeline generation that's being created, but we have taken into consideration this new mix of the buying behavior, which results in a knock-on effect of lower in-year revenue, in-year cash as a result of that. So that change in mix puts a cooling effect on the overall expectations for the business for sure.
But is it the case that you put the remedies in place, you've adjusted to the new market environment, and therefore with the shares down basically back where they were at the beginning of last year, one could almost say this could represent an opportunity in the same way at 8p a share as they did at the beginning of last year when the shares were 8p a share?
Yeah, Zach. You can, when it comes to how the market values things, it's a little bit of a clairvoyancy, right? And how people view things or don't view things and so forth. My perspective on the business is I'm still extremely resolute about the business prospects. And from where I've once come, the idea of having an ARR business, which is what most people in cybersecurity investing want out of their cybersecurity investors, when you have an ARR business that's growing in the upper 20% in cybersecurity, that's essentially a desirable business by any stretch of the imagination. The rest of it will, I think, tone itself out in terms of the knock-on effects on the P&L and this transition from mostly CapEx to mostly ARR OpEx models as we go forward. And this has been a dramatic change for us, and I think it's been precipitated. My personal feeling is that this has been precipitated by this change on finance officers in our customer base that have had a more interest in intangible purchases as opposed to tangible purchases. In other words, those purchases that are not subject to tariffs. They just philosophically have decided where they once were okay with CapEx and how that could help them on their P&L. Today, they want to insulate themselves against this world of tariffs, and they buy now more intangibly.
I guess just to clarify on that point, Zach, our products are exempt from tariffs at this stage. It's more a sentiment that Carl's referring to.
Yeah.
So in a way, we need to see how that pans out. The bad news is already factored in. It could be that tariffs have much of a less impact or no impact on you at all, and you're almost back to where you were 6 months ago or 9 months ago, something like that.
Yeah, it's a philosophical change in buying, I guess is the best way to say that. That's something that we didn't see coming. We're not subject to tariffs at the moment. You know how it is every single day. The temperature is different. But at the moment, we're not subject to any of the tariffs. Having said that, the way that buying has occurred seems to have changed, at least for IT and cybersecurity services.
Okay, well, we'll see how everything pans out. Obviously, Donald Trump's probably not on your Christmas card list, but in the meantime, Carl Herberger and Chris Goulden, thank you very much indeed, and hopefully we'll catch up soon.
Thank you very much.
Thank you, Zach.
Bye-bye now.